Saudi Arabia was forced to shut down operations at its most critical oil export hub, Ras Tanura, after an Iranian Shahed-136 drone strike triggered an immediate precautionary halt across the entire facility. Ras Tanura is not merely one refinery among many, it is the kingdom's primary refining and loading hub on the Persian Gulf coast. With a crude distillation capacity of 550,000 barrels per day, it processes roughly 31% of Saudi Arabia's domestic refined product needs, while its attached marine terminal serves as the world's largest crude oil export port, handling approximately 75% of the kingdom's total oil exports. Saudi Arabia currently produces between 10 and 11.2 million barrels per day of crude and exports around 7 million barrels per day. The sudden offline status of Ras Tanura therefore removed 550,000 barrels per day of refining capacity and disrupted loading operations that normally move millions of barrels of crude and products daily through its North Pier, South Pier, and Sea Island berths, capable of handling up to 16 supertankers simultaneously. The actual impact unfolded rapidly. Within hours of the strike, Aramco confirmed a small fire in one processing unit, which was contained, but the decision to shut down was taken to allow full safety inspections and damage assessment. Refining output at the site dropped to zero, representing an immediate 550,000 barrel per day loss in gasoline, diesel, jet fuel, and petrochemical feedstock production. Export loading was also halted as a precaution, meaning tankers already scheduled for Ras Tanura had to be diverted or delayed. Industry sources indicate that this terminal normally accounts for the majority of Saudi crude shipments to Asia, Europe, and the United States. Even a short-term disruption of 48 to 72 hours could translate into 1.5 to 2 million barrels of delayed exports, while a longer closure, measured in weeks, could compound the shortfall. Crude production from upstream fields remained unaffected because Saudi fields can continue pumping, but the bottleneck shifted downstream, where refined products and export logistics are concentrated. This development matters on multiple levels. For Saudi Arabia, oil revenues still fund nearly 40% of government spending and underpin Vision 2030 diversification plans. Any sustained reduction in export volumes directly hits fiscal income at a time when the kingdom is already managing lower OPEC+ quotas and rising domestic energy demand. The psychological blow is equally significant. Ras Tanura had long been considered impregnable after the 2019 Abqaiq attacks prompted billions in upgraded air defenses, including Patriot systems and layered radar networks. Yet a single low-cost Shahed-136 drone, estimated at $20,000 to $50,000, succeeded in reaching the heart of the complex, exposing persistent vulnerabilities to slow, low-flying threats that traditional systems struggle to counter reliably. This forces Aramco to divert resources toward counter-drone technologies, directed energy weapons, and AI-driven swarm defense, while accelerating plans to diversify export routes through Red Sea ports like Yanbu. Globally, the strike sent immediate ripples through energy markets. Brent crude futures jumped on news of the shutdown, reflecting fears of tighter supply in an already tense environment following the U.S.-Israeli campaign against Iran. Although the physical volume loss is modest compared with global daily consumption of roughly 100 million barrels, the symbolic targeting of Saudi infrastructure by Iran raises the risk premium. Analysts note that even a brief 550,000 barrel per day refining gap, combined with export delays, can tighten product markets, especially for middle distillates that Asia depends on from Gulf refineries. If the shutdown extends beyond a week, the cumulative shortfall could exceed 4 million barrels of refined output, forcing buyers to seek alternative supplies from Europe or the United States at higher costs.